Well, good morning, everybody. My name is Matthew Mims from the Investment Store, and I'm delighted to welcome you all to this latest investment briefing from Devon Funds, featuring Portfolio Manager Slade Robertson. So in today's update, Slade will touch on a few key macro issues, talk about the recent reporting season, and also update you on one or two key holdings within Devon's portfolios. Please note, nothing in this presentation is or should be deemed to constitute financial advice or a recommendation to purchase a product. Information is provided for discussion purposes only. Now the session is going to last for approximately 15 minutes, and we will allow some time at the conclusion for any questions that you might have, and I would encourage you to ask questions as we go along. You should have a questions box that appears on your screen. So at this stage I'll now pass you over to Slade Robertson. Slade.
Thanks very much, Matt, and thanks everybody for dialing in today. It's it's always a real pleasure to get these chances to talk to you about what we're doing here at Devon and how we're seeing the world. As Matt mentioned before, what I'd like to do today is start by just talking a little bit about what's going on in a global context for investors, bring it back home to New Zealand and Australia, look at things in an economic context, talk about the reporting season, and then talk about portfolios and some of the, what I think are some of the really key and very exciting opportunities that we currently have in the funds. It really has been quite a fascinating start to this month, and it's been a very volatile time both in the bond market and the equity market. And I just had a quick look at the way that our funds are performing, given that's the environmental backdrop, and we're doing very well. I think all the funds are substantially ahead of their benchmarks, and that's not a big surprise to me. We and all of you know this. We manage money in a reasonably conservative way. We're very valuation and quality focused. And this is an environment I think that really does suit the way that we manage money. So very, very pleased with the way things are going. And it's not just because of the cash weightings we have or the defensive sector positioning. We really have some quite, I think, very exciting stocks in the portfolio at the moment. So I'll run you through some of those in a minute. Just having a quick look at what's going on globally, and I don't want to spend too much time talking macro in this call, but it really has been quite an interesting start to this month, and I think this is a great chart. It's the guys at Merrill Lynch do quite a lot of good work looking at global asset flow and positioning of the fund managers that they deal with, and you can see that there's just been this enormous amount of money going into those assets which are tied ultimately to expectations that we have very low interest rates for an extended period of time, and what this is showing is the IG is investment grade debt, high yield debt, REITs and dividend funds, and you can see just this massive amount of money has gone into it. Now the reason that this is fascinating, and the reason I talk about it in context of the volatility that we're seeing at the moment, is that whenever you have a huge amount of money and a consensus, if you like, building around a particular theme or asset class, what happens is that you lose the ability to tolerate any shift in a negative way with the backdrop or the key drivers supporting that asset class, and that's what we're seeing in the fixed interest space at the moment. And I was having to think about this morning coming in. It's in the past couple of weeks, what you really have seen has been a big breakdown in the performance of the fixed interest markets globally, and this is what has conspired to leading to the equity market volatility. And the reason this has happened is a couple of things. So in Japan, the policy setup there has started to change, and with the government now, for the first time in a while, really focusing and emphasising fiscal spend as being a key driver. The central bank in Japan talking about a desire for a steepening yield curve. Now that's a big change. In the US, we had the economic symposium at Jackson Hole, and that was a real chance for the Fed to float and develop their optionality around lifting interest rates between now and well, certainly over the medium term. And they do this. This is the way that the Fed operates. They like to float suggestions out there with different governors and just test the tolerance for broader asset markets to that kind of event. And I guess they would have been a little disappointed with the degree of volatility that they've seen subsequent. But the big question I think for investors now, and it's just my own personal view here, but really is what happens to interest rates from here, and if they do go up, what is the likely impact on equity markets globally? My view ultimately is that that we are in a world where it's kind of hard to see that interest rates or economic or monetary policy, if you like, goes a lot lower from here. In the same breath, I also find it very difficult to see a world where you get policy misstep by people like the Fed. I mean, they've put a lot of effort into looking to rebuild economic momentum and confidence globally, and I think that any expectation that we'll see them misprice the short end of the curve, and at a time when you haven't got inflation concerns globally, and certainly in the US, I'd be very surprised at. We have one of our guys, Chris Gaskin, in the States at the moment, and he's currently doing a range of meetings on the West Coast, and one of them was with Westfield a couple of days ago. And it was a very positive meeting economically. I mean, those guys are quite upbeat around the retail environment and what they're seeing. But again, it's not transpiring into inflation risk. So I don't think the Fed will move too aggressively. And I think as a consequence that what has been very supportive for equities for a long time now has been this low risk-free yield regime. I think that will continue. That doesn't mean that we won't have periods like we're going through now where you get volatility. But I think we will see rates lower for longer. I'm certainly in that camp, and I think it will remain reasonably supportive for equity markets. Just having a quick look now at New Zealand and Australia. It's I did laugh the other day when I saw the rockstar economy again being used in the New Zealand press around New Zealand's economic performance. And they're right in one context. Things are going well in a real GDP sense. Things are moving in the right direction. One of the issues that we've highlighted before with you is just the impact that immigration's having on New Zealand. So if you break it down and look at the economic experience and progress that's being felt by individuals here in New Zealand, it's nowhere near as positive. So immigration's been a key driver, and that is manifesting itself, if you like, in construction and housing. This is not an environment, though, where we would typically, if you go back through previous economic cycles, be talking about cuts to interest rates, but we are at the moment still. This is the RBNZ has a very clear mandate around inflation targets. They're not hitting those targets, so the expectation is in this market that we will see further interest rate cuts. I suspect that we probably will in New Zealand. But net, I think it's still not a bad backdrop for the equity investments we're making here in this market. Australia's a bit better than what we're seeing here in New Zealand, and it's really encouraging for us. And I'll talk about the reporting season in a moment. But we have been through a period recently where we have spent a lot of time with management teams across both New Zealand and Australia, and there's really clear signs that the economic rebalancing that's been going on is working. And this is manifesting itself in some quite positive economic data points. And I think the other day I saw the terms of trade up for the first time in I think 2.5 years. That's encouraging. GDP growth strengthened to around 3.4%. So that's, I think, the best again that we've seen on a year-on-year basis in over 2 years. So really quite positive stuff going on. And when we look forward, government spending will again play a role in a positive way, and net exports will again continue to be quite supportive alongside a housing market over there, which albeit there are people out there calling for the end of it, still has some reasonable momentum behind it. Just talking quickly about the reporting season, I did write something about this in our last monthly commentary, and the reporting season for us is this wonderful window into what's going on, genuinely in the corporates that we invest into, and albeit we do speak to them on a very ongoing basis, it is a great chance to really sit down with them all in a very concentrated format and time period to piece together a plan for our investments and our portfolios going forward. This chart here looks at Australia, and look, it was a reasonably tough time in an aggregate earnings sense for Australia over the past 12 months. And when we look at Australia, we do have the benefit there with some big sector representation to break it down, as we have done in this chart. And you can see one of the big drags was the resources. Now, they got smashed in terms of their economic performance during the year ended June 2016. This came on the back of what, again, you're all very aware of what's going on in China in terms of changing economic profile, in terms of demand for commodities and the implications that has had on pricing. So that really did weigh on the earnings for that sector. And but the expectation is that we'll almost see a full reversal of that going into the next 12 months. It's been really interesting for us, and this is not a sector that we are overweight. We're underweight it through the portfolios, and it's still a very volatile and uncertain space. But the conversations that we're having with the CEOs and the business teams in this space, are encouraging now much more so than previously, because the focus has shifted away from growth and supply to free cash flow, and cost discipline and investment discipline is something which I think will support the sector going forward, almost to a large degree irrespective of commodity prices, but certainly a more favourable environment there will be supportive for them as well. The industrials is a mixed bag. There was some disappointing results with the offshore earners. Some of the domestic guys delivered very, very good outcomes. People like JB Hi-Fi were, and those groups that were associated with housing construction and by a derivative of retail did very, very well. And the banks were down. I'll talk a bit more about the banks in a second, but they were also were a little softer on a year-on-year basis. New Zealand was good. One of the things that you find with companies is that they will, make sure that the market's expectations around earnings, at least for good companies, are reasonably well set going into this period. And New Zealand didn't genuinely disappoint. And there were some highlights for companies like MetLife Care and Fletcher Building. But after the very strong bull run that we've seen here in New Zealand, it was good to see that they sort of met expectations in the market. I guess from our perspective, one of the other key things that came through was, again, further reiteration by boards and by management teams around the dividend policy. Companies appreciate the importance of dividends and yields for investors at the moment, and again, we saw quite a progressive approach, on both sides of the Tasman in respect of that. And the final thing I'd say on this is that from all the meetings that we had, and we did spend a lot of our lives on the road during this period, and we still have guys on the road at the moment, is that there does feel like there's a reasonable tone, especially in Australia, to an improving environment for business and for earnings going forward in the next 12 months. So really encouraging. So it's not just the cost focus; it's genuinely at the revenue line, and especially in the domestic cyclicals in Australia. The expectation is that things are moving in the right direction. Just a quick chat on the banks as a sector. Look, I know it's not the most interesting place to go, but it is very important when you think about investing money in New Zealand and Australia, because it still does make up about 27% of the Australian market. This is quite an interesting chart for me, and what it does is it looks at the different return on equity experience that the banks as a sector have gone through during different environments around interest rates, inflation and regulation since World War II. And you can see very, very different outcomes. The period from early 1970s through to 1994 was a really tough time for the banking sector in Australia. But what we've been through in the subsequent period from 1994 has been almost super profit-like, and it's been because you've seen consolidation in the sector, you've seen deregulation occurring within the space. We did go through the GFC, and you can see the return on equity experience there. But we're now moving, I think, into a new sort of environment, if you like, or paradigm, and this is one which will be characterised by super low interest rates, by deregulation. And I guess the big question for the investors, like us at the moment, is, what does that mean for the banks? And it actually feels pretty tough. I mean, we sit there at the moment, and we're underweight in the Australian fund, we're underweight in the Trans-Tasman fund, the Alpha fund, which has the flexibility to either be on or out because it isn't referenced to an equity index. We don't own a bank at the moment. We do a lot of work in this space, but if I think about where we sit today, there is continuing pressure on interest rates. There's a lot of competition still around funding and around lending, and it does feel as if this cost of capital, the return on equity will begin to migrate lower towards the cost of capital over the next period for these banks, and as a consequence, that will suppress some of the upside risk that exists here. There will still be opportunities to go in and out of them, but I think as a sort of a longer term or medium to longer term view, it's our view that this will remain a more challenged sector than what it has been in the past 20 years. Now, just on a much more positive note, a stock that we've talked a bit about with you guys recently is GTN, and this is the sort of represents global traffic networks. This is the company that does all the traffic reporting in Australia for the TV networks and for the radio networks, and they use the information and service they provide with the traffic reporting to these affiliates, and they receive back from them the advertising spaces, which they then on-sell to in a sort of a national network sense to the big advertisers. And this company's doing so well, and you spend your life in this job as an investor, just always searching for the next big sort of nugget, if you like, and this is, we are very excited about the prospects around this investment. So we invested into it about 5 months ago at $1.90. It's now trading at which was in the IPO. It's now trading around $3.15. We still think that the optionality and the upside risk to this is quite significant. It was a really good result from it in terms of the overall company earnings for FY16. So they beat principally in terms of top line revenue growth, which was great. The chart you're looking at here is just Australia. So this is a company which is seeing massive upward earnings momentum in Australia, but they also have exposure to Canada, to Brazil, and in a very exciting sense, and still very early stages, but in the US. And it's in the US that we think that there is some massive optionality for these guys. And in fact, they have done a deal with a group called Radiate, where they are looking potentially to buy that business, and that's a large traffic information provider in the US. If they were to be successful with this, and it's not a given, but if they were to be successful, some of the contracts that could come from that would be very exciting for this business. But I guess what excites me is the fact that we think that the current business currently justifies the share price, and there's a lot of sort of underrepresented optionality on the upside in the current share price. So this is something that we will talk a bit more about with you guys going forward. But it's already delivered this month. I think it's up another 25% in a market which is down. So these sorts of investments we have in the portfolios, and it's something that's getting the guys very excited. Finally, Healthscope, and again, it's a business that we have spoken to you about before. It's the second largest private hospital operator in Australia. And again, a really good result by this company. And it wasn't that they necessarily smashed expectations in the market, but there were some negative views out there that some of the current government reviews that have been going on in the healthcare space would have represented themselves in a declining experience with long-run admissions into hospitals in Australia. That wasn't evident at all, and so we have seen a nice lift in the share price post the result. And this is just a company which will never deliver the sort of, from where we are today, the sort of upside returns that we've seen in a company like GTN. But it's really important when you're building portfolios for you and for your clients that we have, a really good mix of businesses. And it's wonderful for me to see in the portfolios that we have companies like Healthscope, which has got this awesome demographic tailwind, if you like. You've got great management, good balance sheet, and they're just sensible guys operating in an industry where they built up a really strong competitive position. And again, to have this alongside some of the more, I guess, the more exciting opportunities is where we get better quality portfolios. So listen, that's all I had to sort of say, but I'm really happy to answer any questions you might have.
Okay, Slade, so thank you very much. We'll just kick off with a question on the alpha strategy. Do you see the cash within the alpha fund, which I know has been quite high, falling or rising?
Yeah, look, thanks, Matt. It's yeah, look. Currently, we're sitting still around that sort of 35 to 40%. It really is one of those things. We have been investing and taking positions like GTN higher in the portfolio, so it currently sits at around 7% in the fund. So when we find good ideas, we are really determined to make sure that we have the right sort of representation in the portfolio. So as opposed to taking and answering that on a macro basis, it really will just come as a consequence of finding those sorts of exciting opportunities. And the guys, as I said, Chris is over in the States at the moment. Tama and Nick seem to be spending an enormous amount of time in Australia and travelling around New Zealand, meeting with companies, as have I done. And we have got some good ideas coming through. So just dependent on where we get to in those in that investment research process, will determine how much cash we can have in that portfolio.
And Slade, any comments on the relative value between Australia and New Zealand at the moment?
Yeah, look, it's interesting, isn't it? It's look, I think if you look at it on a basic PE basis, New Zealand will looks more expensive than Australia does if you take out the banks and the resources and look at it which is a fairer way of doing it, to look on the industrials. It's been interesting in the last couple of weeks. New Zealand, for the first time in a long time, has been underperforming Australia and actually other markets globally. And the reason for that is that so much money is sitting here in New Zealand on account of the high dividend yield that we offer. And we've talked in the past about the fact that almost 50% of this, actually over 50% of this market now is owned by foreigners. So if we do go into an environment where interest rates do start to pick up, New Zealand will be at particular risk, I think more so than what Australia will be. So on a valuation sense, Australia over New Zealand looks better. New Zealand, though, will do very, very well if we see just this sort of lower for longer interest rate environment. I think some of the opportunity sets that we're still seeing in Australia, like the GTNs, are more exciting for us. So, as opposed to thinking about it in a one market over the other sort of basis, our investment process is very much just really treating it as one market and just trying to find the best ideas we can across it.
Okay, probably just time for one more question, and just sort of shifting away slightly. There was a new fund launched at the beginning of the year, the Diversified Income Fund. 6 to 9 months in, can you just make a quick comment on how that fund is progressing?
Yeah, look, thanks, Matt. It's a good question. It's going really well. I mean, the returns, it is benchmarked against the OCR plus 1.5%, and it's substantially outperforming that benchmark. And a large part of that is due to the contribution of the dividend yield fund. But we're really pleased with the way in which the bond portfolio has been performing. We have worked in conjunction with the team at JB Ware to build that and do so on an ongoing basis. But no, they're a great team. It's working well. We're really, really pleased with the returns, and there's been good client support for it. I still think we live in a world where people are looking for returns which are better than what the bank offers, and if we can do it in a way where we have a really measured and careful approach to building a bond portfolio to deliver those sorts of returns, then I think it will continue to be very relevant going forward.
That's great. So I think we'll wrap it up there. A quick thank you to Slade for his time today and putting the presentation together, and thank you also for taking the time to dial in. We hope you found it enjoyable. We'll be back in about a month or so to run another one. We will do a follow-up note and link through to a copy of the presentation today. But on that note, thanks very much and have a good day.